By the way, we have very smart cash data to work with this. The ES is different than crude oil. And one of the reasons we started with ES first is because it's liquid, you could scale, it's magnificent. However, the volatility is not as big as other markets, so you can make more money in other markets. But what the ES offers is what we call cash prices. So fundamentally, the S&P 500 futures contract must track the value of the S&P 500 components. Just the way it is. It's built on it. So as that equity basket changes in value, there is stuff happening in the market that impacts that on the equity side. You're looking at straight futures data, but we can actually then incorporate all the relevant equity data into the model, because these R bots are out there. When stuff gets out of whack in terms of value between the futures and the cash prices, the R bots come in and reconcile that. And what they do is they scoop up that delta in value and they shrink it. Now, that gap in value or delta in value, where there's an expansion between what the futures are worth and what the equity component is worth that you can shave down, I think that even though people have been playing that R-bot game for 20 years, there is still enough room for us to jump in it. Not on every minute, every day of the market, but there are aberrations where we can see absolutely, just like the rest of the world, if they so choose to look, that the gap is extreme. And then if the gap breaches a certain extreme level, let's say 2.0 is the extreme level, then the R bots from Fidelity and Goldman Sachs and Renaissance will kick on and then diminish that. And then what I think is we can, if we introduce that cash data, we can then piggyback on the work of the R bots collapsing that spread between cash and futures.